Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending March 27, 2020. I'm Preston Brent. Thanks for tuning in. This week's theme is Follow the Bouncing Ball, and boy, has it been bouncing. I mean, the entire week, we've had a really strong week for all U.S. indexes. In fact, for all global indexes. Last week was horrible. This week was met by an equally uh, counter move to the upside. Now, I know a lot of people are wondering, is this a bull trap, that kind of thing, or a bear market rally, just more of a short squeeze before it rolls back over? I'll get into that in a minute. But just looking at this week, the Dow was up almost 13%, a little under 13%. S&P was up over 10%, NASDAQ over 9, and the Russell was almost 12%. And if we look at all the indexes around the world, the major ones anyway, the London index, the FTSE was up over 6.5, CAC 40, French index over almost 7.5. Excuse me. The DAX was up about 7.8. The Nikkei, oh my God, the Japanese Nikkei index was up 17%. China was about flat. I guess it's flat in this kind of market. It was about 1%. Hang Seng, the Hong Kong index, was up just under 3%. And to give you an idea of the sector performance this week, the best performing sector was utilities. It was up a whopping 17.33%. While the communication sector was the worst performer, still up though for the week, 3.76%. Man, got this coughing. No, I don't have COVID-19. Come on. But you never know it, right? But I don't have it. But anyway, looking at the week, really a strong week. Now everybody's wondering, where are we? Where does it put us for the week? Well, if we look at the current trailing PE ratio, is at 20.11. And if we look at the forward PE, is at 15.82. So the forward PE ratio is lower by 21.3%, right? The annual dividend yield is at 2.41% for the S&P. Really very strong. 10-year interest rate sitting at about 0.74%, almost 75 basis points. So we've got over a 1.5 difference, just about, between the S&P annual dividend yield and the 10% interest rate. So that's still going to funnel some money into the markets, although right now I'm seeing buying around the fringes. But this past week, outside of Monday starting off slow, Tuesday, Wednesday, Thursday, we had the biggest gain since 1931, Great Depression, in the S&P and the Dow and the index. Everything just took off. I mean, but if we look at it as we closed out the week, 8 of the last 9 weeks, basically, we've sold off into close on Friday. More of a profit-taking mode going into the weekend. No one really wants to be holding a lot of longs, at least short-term longs anyway, so they've been committing them up. But we've got this market strength. It really, I believe, came about as much, if not more, to a massive short covering rally. We did see some new money come into the market, but not a lot. We're coming into a quarter end too, where we get some rebalancing of portfolios. We're getting the 60-40 pension fund rebalance, and it may not be exactly 60-40, but obviously, in order to maintain the balance ratios, I think a lot of pension funds are going to be required to sell bonds and buy some equities to keep that ratios that they've got there. But we've got ultra low treasury yields, as I said, so bargain hunters are coming in, me included, rushing in back into the markets to pick up some key stocks, some that are paying a lot higher dividends. But if you're going to be buying stocks now, think like a lender, as I said last weekend, think like a lender and get those stocks that have high cash balance sheets, fairly structurally strong, so that if they are paying dividends and they're a lot higher, they're committed to them more so than other companies, because we're going to see companies start to cut dividends in the interest of conserving cash. Now, in the State of the Union address in 1996, I saw this. Clinton said the era of big government is over, but well, not quite. In a month's time, we've seen the U.S. economy moved from really the best employment and expansion period in history, lowest unemployment. I mean, just everything was just strong. And in less than a month, we've moved kind of into an abyss. Okay. The move has been really shocking, unexpected by everybody. It's a true black swan event. And given this year, with the algos, the increasing movement and technology playing a bigger role in moving money around, the huge amounts of money held by passive index funds, that's caused the resulting market movement to be bigger than most people had expected or anticipated. You know, we've seen the Fed slash key interest rates down to about 0 to 25 basis points, and they've come in with a QE program that starts now at 700 billion. But they've come out and said we're going to do whatever it takes. And on top of that, U.S. Congress has passed a 2 trillion stimulus package, which really exceeds the 2008 financial stimulus that came out in the financial depression back then. Trump signed this into law this past Friday. And the way the feds are working with the leverage that they're doing with their stimulus, that'll multiply the 2 trillion stimulus that the US government came in that fiscal package, you know, at least by another 4 trillion. So that gives us about 6 trillion, maybe a little bit more to fight the short economic engine as we flip the switch off, really, which is a little bit more than 8 or 9% of the US GDP. You know, quarantines around the world pretty much have had a severe impact on the global economy. It effectively have shut the economic engine down everywhere. Now, this is where I disagree with a lot of the liberal Democrats out there that have said this is a bailout of corporations. Apparently, they don't know their history, nor do they know economics very well. You, this is the when you put a bullet or a gun to the head of companies and tell them they must shut down, all right, through no fault of their own, other than just this black swan of this COVID-19, forcing them to shut down, forcing them to run into cash flow difficulties. The government's going to have to make good on that. Okay, unlike 2008, yeah, bailouts were plenty back then. I disagreed with many of those back then. We, you know, in our membership, even back then in '08, we had members. I was standing up saying that we don't need to bail out some of these banks that were of their own making in these issues here with their off-balance sheet structured leveraged deals and CDOs and all this kind of thing. That just, it was a mess. But this is completely different. I don't view this as a bailout. All right, this is to make whole an economic engine that basically we just flipped the switch into the off position, and hopefully we can turn it back on in the next probably no more than another let's say 8 weeks, 4 to 8 weeks. I hope we can flip it on, but not just entirely, in sections of the country, and then we slowly bring this dimmer switch back up and fully light the room again. That's what I'm hopeful for. If we don't, then we're going to see some more downside in the future. Right now, another risk to the global economy as everything shuts down like this is more about deflation. And believe me, folks, the Fed, central banks globally fear deflation more than they fear inflation. All right. Virtually all commodity prices have fallen dramatically this month. I mean, and you don't need to look any further than the oil markets. WTI going into the teens before finishing the week just slightly above $21 a barrel. And we got very low interest rates. So the biggest key to fighting deflation really is to get that switch back on and get the economic engine running again. Once we get this moving and business shutdown restrictions are beginning to lift, we'll see an immediate reaction across most commodity markets as asset prices are essentially reinflated again. But then that's going to flip the switch back into an inflationary mode. Now, we've been in since the 80s, interest rate wise, we've been in this huge bond bear market or bull market where bonds have just been going higher, interest rates, you know, since the Jimmy Carter era have been coming down. But I think this switch here is going to flip us into an inflationary mode. Not now, not anytime soon, but over the next 2 to 4 years, 5 years, we're going to see inflation start to rear its ugly head again. Okay. So we've got a number of things that are moving around in the economy right now. And one bit of good news, um, and people are now putting economic models together to measure this. We're seeing China's now getting back to work as they're beginning to lift their lockdown on Wuhan. Factories are starting to open. People are getting back to work. So we're seeing that as the COVID-19 epicenter have moved to Europe, and now we're seeing in the U.S. The U.S. has now surpassed the world as far as the total number of cases, of which in the United States, over 50% of the cases are in New York City. Okay, that's going to be shifting around as we see New Orleans come up. We're going to see Chicago and other major cities come up, probably not to the degree of New York City. And if you look at the number of new cases versus the peak, just looking at it, we probably have another 2 to 4 weeks to go before we start to see peak load in the United States. Let's say 3 or 4 weeks, 5 on the outside, and then that peak load's going to start coming down. And that's going to affect the U.S. markets, because remember, the markets don't price in the price action today. It prices in what it's going to see 90 days, 120 days out in the future. Okay. Now, if you look at the screen, I've got an Ichimoku chart, and I've got it on a 240-minute time frame. I love this time frame because it kind of gives us an X-ray view of the daily chart. Okay. And it's a little bit better than daily, but it's close to daily as you can get. Now, if you look at this, you'll see the red line here, and I've got a blue line. The blue line is a little bit more flat. You see it doesn't curve and bend as much as the red line. The red line, now in our option masters, I spent a lot of time going through how to use the Ichimoku, and I use it often, as you can see, because it really gives you a better idea and appreciation, more than just simple moving averages or exponential moving averages, of where potential support and resistance lines lay. And if you put that on top of Elliott wave analysis and key pivot points, you've got a fairly good idea of where things are going to be, probability wise. You're trading always the right hand side of the chart, so everything is a probable move, but that's kind of what you're doing. And just briefly here, because I show it often, I thought I'd just kind of give you a quick highlight here. That's really a 9 SMA, all right, but it's not the SMA that you may think about, because a typical SMA just drops off the last. If this was a 9 SMA, it'd drop off the 10th day. So you're always running forward, and it takes a simple moving average. But what the Ichimoku does is it takes the high and the low of the day and divides by 2. So it never really, it factors out the low and the high, takes the middle, and it gives you a truer, probably volatility adjusted kind of moving average. And then the blue line right here is the same thing, only it's 26. And again, it's not a simple moving average like the 9. It takes the high and the low and divides by 2. So that's why, unlike a moving average, you get these flat lines like this. In a moving average, it would never be flat, but here you get these. So it's a volatility adjusted in a very creative way how it runs. Okay. Now, the other thing that probably most people know of when they hear the Ichimoku, they see these things that they call a cloud, right? And I've got my colors adjusted, so I've got a red cloud here and a green cloud here. The clouds really basically are an attempt to show where the market price action finds support and or resistance. Because we're above this red cloud, I call it our R1 zone, which is, once we get in here, we can expect chop and a little bit of support. If we fall through that R1 zone on this chart, you will see this big colored bar here, which is a combination of Gann and Fibonacci. So I use e-signal. I've got a tool that can plot this on my screen here, but I could also do it by just using Gann and Fibonacci. Gann using more of a time series and Fibonacci using a price series, although I could do time and price on both those. But just looking at this, it combines both and gives a best guesstimate probability of where it would be. And it shows it right around, let's call it 2100 in the middle, but it kind of runs up to 2100 here. You can see the yellow dashed lines on my screen are key pivot levels, okay? And then you can see these colored lines here are key fib nodes. And these key fib nodes go all the way back to March 9th lows of the financial crisis in 2008, 2009. That would be March 9, 2009. And the high up here, all the way up here to the recent highs made in February before we rolled over. And you can see where we've got a lineup of a fib node, right? And a key price level. That would be an area of congruency where it tends to be even stronger support and or resistance depending on the approach. And then you can see, though, we've got a nice little area here, which is kind of at the bottom of this cloud, red cloud, which would provide support. Should we break that cloud to the downside, as I was telling our members, we've got a free fall. I don't have it marked, but that was the prior lows here. Okay. And if we hit these prior lows, then we're going to probably come down and then fall into this zone right here, which takes us, as I've been telling our members, let's just call it around 2000. Okay. So a lot has got to happen for us to move from the close here in the E-mini futures of 2520 down to 2000. That's 520 points, folks. And I'm not saying that's what's going to happen, but that's a big move, right? And if you take a look at the market price action, just take 520 and look at it from the current price of 2520, that's another 20% move to the downside to get down here to that level on top of what we've already given up so far. And that's where we can go to find even firmer support. Now, I'm not suggesting that's where we can go, but on an Elliott wave analysis with a 3-leg, a 4-leg, and then a 5-leg, this could be a complicated 4-leg pattern where it's an extended pattern. Maybe we don't make it all the way down. Maybe we find support here at the prior lows, okay? But this is suggesting that do not be surprised if we take out our prior lows and carve out one final lower low before we start to form a consolidation pattern down at the bottom before we move back up. Okay. Now, so that's a lot to think about and a lot to digest. And rather than just guessing, I also take a look at the key crossover of the 9 and the 26 specialized SMAs in the Ichimoku. And you could see here on the 25th of March, we had a buy signal right here on this. And now we've moved up. We actually moved north of the cloud, and now the cloud is kind of providing support as we move forward in time. And it's it's a red cloud. It's what I call my S1 zone. Now notice over here the cloud is green versus red. That is a little bit of a bullish signal that suggests that the market action, according to the Ichimoku, could shift over to a bullish mode as we go forward in time if these prices hold up. If they don't hold up, you'll see these lines cross, and now it'll go back to red again, coming back down in that area down there. Okay. Now, the other thing that I'm watching for here is the indicators down below. You can see with the RSI, before we got the cross up right here, right in that area there, the RSI moved above the 50 level, right? And we've stayed north of 50, really since about early part of the 24th. So most of the week in this bull run, we've been above 50. Should we move back down below 50 again, then we're probably going to move back into the red here. You can see this red, which is the 9 SMA, specialized SMA, is holding us up. But if we come down, we're going to test this level right here. Okay. One area of a little bit of a bullish suggestion by the Ichimoku, again, is you can see this line right here. Notice this line right here is a lagging line. It's the purple. It's purple, and it tracks the current price, but 26 bars ago. And if you look at it, and if it's above the current price, which it is, it tends to be more of a bullish sign. If it's below the current price, it tends to be a bearish sign. Okay, so this is showing just a little bit of a mixed signal where we've got Elliott wave analysis suggests we can come down. We got a green cloud that suggests we could possibly chop out and then start to form a bottom. And then we've got the 9 over the 26 suggesting that it's bullish, but we could expect a pullback into this area here. So all of this is suggesting, I'm sad to say, more chop, probably a little bit near term, more downside action. But should we break this level here, right around the 2316 area, which is around the bottom of, and this is the E-mini futures, then you can pretty darn well expect we're going to come down, test these lows very quickly, and then we're going to come down and we're going to find ourselves down around this 2000 area. Okay. So that's just a little bit of this in detail. Now I will show you, let me just step it out a minute and let's go look at the monthly. We'll do an Ichimoku on the monthly and you'll see a little bit of a different picture here. If I come in, I look at this on a monthly chart here. Let me just put it on monthly here like this. You're going to see the cloud The last time we saw red beneath was coming out in 2013. Okay. And you could see here we went into a red cloud back in 2010, and price action never has gone below the cloud back since 2010. Okay. Or the end of 2010 going into 2011. And now you can see right here, we found support right at this key level here, and you can see the cloud takes us all the way down to around the 2312, which was the December low, and then we've got our low here that came in at around 2168. Okay, so this is, and then you could see that colored bar that I showed on the 240-minute chart. It barely shows up right there in between these two key levels there, which would be another firm area of support, right around 2117 down to the 2031, which is the 50% fib node from the all-time highs up there to the March 9th lows, going back to the financial crisis. So we've got a lot of support in this area. And you can see the extreme wide range of this bar. I mean, this is the bar just for the month of March. And we've got, 3 or 4 days left in the month of March. There's that wide bar here. Okay. Which means going forward, if we don't take this low out, we'll probably have an inside month where we're inside the previous month's bar. And that shows a lot of indecision. And that would still keep us either here in the green cloud. The cloud is still green, because remember, when we started coming down, we've got a very strong economy, extremely strong. Okay. Notice here, this is the first time we've gone down in depth on the RSI. We did it just a little bit when we went into Q4 of 2019. But since then, we haven't been in it for quite some time. Okay. In fact, if I were to just clear my screen out just to show you, if we come all the way back, you can see the last time we were in it was back in 2011. Okay. And then we got really decimated back in the financial crisis back here like this. Okay. So this all shows that, assuming we can get through this over the next 8 weeks, markets may find a lower low, but I think that's going to be it. And then I think we'll be able to move forward. Now, what that does project, I don't believe it's going to be a V recovery. It's going to be more of a U recovery, because companies are not just going to be able to get on as fast as you would expect. China now is starting to get all their factories open again, as I said, but who are they going to sell to? Europe's not buying. The US isn't buying. A lot of the ships coming from China aren't allowed to be offloaded in the US. They're not working. So they're just going to wait. It's going to prolong their agony. So generally the last one to come back online is going to be the best to benefit. And we're going to be the US, because we're the last ones that's going to come back online again. And Europe will be back. Their number of new case load will be coming down when the U.S. is in the middle of peaking, and then the U.S. is going to start to come back down. But even if all of this, we turn the engine back on, the consumer spirit has been a little bit mangled. And I think with all the social media and all the hype and a lot of these TV reporters that are just trying to hype the hell out of everything and scare the hell out of everybody, I think consumers are going to be reluctant to get out in large groups. But eventually, when the all clear is lit, I think over the next 90 days, you're going to see a huge pent up demand. And then we're going to see a huge rally, probably Q4, Q1 going into 2021. And we'll probably get a really extended rally through 2021, 22. And then we're going to have some major problems in 23 and 24. So for our members, I'll talk a little bit more about that in detail later, which we'll be able to take advantage of. But right now, no. Okay. Now you can also see on here, as this thing was moving up, you could see that huge, massive divergence, right? As price action was here, we made a higher high and a higher high up here. Each time the divergence was getting worse and worse. That meant each bullish run here was weaker and weaker. Okay. And we had several signals here that said, watch out. Okay. Not to run for the hills, and you never know what's going to set the markets off. This was a black swan. A normal drop would have been 10 to 15%. All right, a black swan has moved us over 30%, which could take us to 50%. But we did get the warning here, fair dinkum, right? We did get the warning that said start to take some profits. as I was suggesting to a lot of members in our group. So that's a little bit about what we're sitting here. What I want to show you now, I just want to take you over. Let me put this back on my favorite time frame, which is the 240-minute chart here. Okay, so let me just take you over. Let me just get this screen set up for you here. I'm going to move you over to the I got a dozen monitors here that I'm running around from here. So let me put it on a daily chart, and let me take you over to the volatility of the VIX, because this is another thing we want to follow very closely when the markets are like this. Okay, screen number 5. Okay, here we go. So I'll wait for that to paint on your screen here. But as I've been telling our members, we've seen some volatility instances here that we have not seen really since '08. In fact, it's even worse than '08. Now, an intraday spike in '08, as you can see on the right-hand side, took us up to 96.40. All right, so this was an intraday spike, this level right here. All right, but we've actually closed several days over 80. And in the financial crisis, I don't think we were able to close over 80 at all. We had intraday spikes, but I don't think we closed over 80. And the reason why we've had such a more rapid move here than 2008 or 2009 is because the algos and the markets are just faster now. You know, it's like pro football is faster. People are hitting further balls in baseball. Everything just moves faster. The technology in the financial world is no different. It's better connected. It's faster in how it moves and responds to headline news, social media, and all of this has just moved this thing dramatically. So we're in my black swan area, which I call anywhere here is north of 50. I call it my VIX black swan. And then I've got colors here, red and then kind of rose, I guess, and then yellow and then green for different option strategies, depending on which different zone you're in volatility. Okay, and we use these quite effectively in following volatility. But one thing I wanted to show you that a lot of people don't realize, volatility at these levels are extremely difficult to hold up. Okay, let me put it on a weekly chart here for just 1 minute. And I'm going to take you back to 2008. So let me just swing it all the way back here. All right. And here you can see 2008. Now I will tell you, what was the low from the financial crisis? The low was in, oh, let me just let me just adjust my screen here. This is something that a lot of people don't realize. Let's just move it out a little bit here like this, so that we can focus on 2008 first. Okay. So this is a weekly chart in 2008. You can see that intraday spike up to 96.40, all right? But now you can see over here on the right-hand side, I've got 85.47. That was the intraday spike that we've had now. But notice we've closed several times over 80. But notice here, our weekly close was always below the 80 level, all right, in 2008. Now, notice here, that's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 weeks we stayed above the 50 level. All right, remember, this is 50 in the black area, which I call black swan. So for 10 weeks, so that tells me that A, we're going to have an extended period of time with volatility above 50. But what was the low of the financial crisis of '08? It was in March 9, 2009. That puts us right about here. That was the lows, okay? Lower than we were here. But notice volatility came down, right? You don't need to be a rocket scientist to see that volatility came down. So the VIX, when we hit our all-time lows, was around 45. Whereas up here, we were averaging around 65, plus or minus 5 or 10 points. So the VIX actually came down as we went lower, because it is so difficult to maintain a high volatility. Remember how price action works. When it comes down like that, the VIX goes crazy, right? The VIX goes up big time, big time. And then when you chop around on the bottom, you have a couple of bull traps, and then it comes back down and it kind of chops around. The overall VIX starts to just gradually come down because the movement actually stays tighter and confined, and you have those 1-day spikes or 2-day or 3-day spikes, bull traps, and then it rolls back over again. But all the while, we're making lower lows while the VIX comes down. Just look at this level right here, right? Remember, the all-time low or the low for the financial crisis was made right here. You would think, well, gee, someone that doesn't follow VIX or understand it would think VIX would be higher here than here, but it's not. And we're going to apply that. You should apply this same formula to where we are now. So even though we can go lower, I would expect volatility to come in just a little bit. Now, there's some nice trades that we're going to run. Notice there were 10 weeks here. All right, so now if I come back to today's market, let's just come back to today. This is a weekly chart, so I'm just kind of getting us all back in alignment here. So we're only we're 3 weeks here, and remember, there are 10 weeks in the financial crisis. Here, we're only 3 weeks in. Okay, and you can see my zones here. The upper zone right here, this is really, this should be labeled zone 5. I don't know why I don't have it on the screen, but I got to put it up there. But this is zone 5 up here. Okay, now if we come down and make new lows, VIX is going to come back down. It'll probably come back down in the mid 40s. Okay, so we can expect that kind of action here. Now, if we look at the front month vol skew, this is another thing that you should be following, which basically is how much higher is the VIX than the front month vol futures. And let me just put it on a daily chart here so that you can see a little bit better. Anything in the red means we're in a backwardation. Now, I've designed this screen here in E-signal. So anything over 0 is in the red, anything below 0 is in the green, and then I've subtracted the VIX from the front month vol futures. So obviously we're in a backwardation right now. And we've been in a backwardation really since February 24th in the front month. Okay. And you got to remember every 30 days or so to change out the front month vol futures because every 30 days they expire, right? I think the third Tuesday of every month, and then the third Wednesday of every month, they move to the next one. The new one becomes a front month series. So the front month now is April. And then in another week or so, or another 3 weeks or so, we're going to move out, and then we're going to get May as the front month. Now, if we look at the back month vol futures, which is April and May, you're going to see we're also in a backwardation to the tune of 8.65 points. That means that the April vol futures is 8.65 points higher than the May vol futures. This is the normal run when you get into a term structure that is in a backwardation. This is another signal. As soon as you run into backwardation, remember we got a backwardation here in early April or February 20th, right? We had already started down before then, but we got that signal around Feb 20. You can see it started to poke its head up above the end of January. And we had in some of our other indicators that I show our members to start getting a little bit more bearish. We picked up some puts, by the way, which are doing very well. But we said some other indicators that had us getting bearish the end of January, early February. So here you can see the back month backwardation, which is even more powerful, showing signs of stress back as early as January 27th. Okay. And then the front month, which is a little bit different because I've had to shift out different vol futures, but back here it started showing signs of stress around the same time, January 27th. So when you get these, you've got to okay, we're now in the red. It's like a weather report where not only is a guy saying it on TV, but you look out the window and it's believable, right? So these right here are giving you're always going to get some heads up warning. Now, what you're not going to get is the severity of what's going to happen. Right now, this just happened to be extremely severe. But what you've got to do is treat each warning as it is, a warning sign. You're looking at the term structure and volatility. You're looking at a couple of other things that I've got here that I show our members. And these are things you just have to watch out for. Okay. But this is something that we can expect. We can make new lows and vol can start to come in. There's going to be some interesting ways that we can play that. Now, if we come over and look at treasuries, let's look at bonds for a minute. The Feds have gone all in. All right, you can see this is what forced the Fed's hand when bonds went up to 91.22. Interest rates just came crashing down, or yeah, and then now interest rates right here force the Feds also, because what the Feds didn't want is bonds coming down like this and interest rates going up while the markets were going up. That's not a good sign. So the Feds are going to try and keep the bonds elevated up here like this, hence interest rates lower for the time being. And they're doing that by reverse repo action to the tune of $1 trillion. They're getting the US dollar down. Now, we had a big move in the dollar to the upside. The dollar's come back down because the Fed intervention. And this also affects interest rates. It affects world currencies, emerging markets. There's just so much here that it's playing with. And I'll show you in a minute what it did to the dollar. But you can see where the bonds are up here in this area. The other thing that I will show you is, let's look at the interest rates. If we look at the 10-year right here, you can see where the 10-year started to move up, and it forced the Feds to come in last Sunday and put that 700 billion back in the game, and interest rates immediately reacted by coming back down. Now, our lows for the year are 39 about almost 40 basis points, but they're going to keep interest rates low with this quantitative easing, buying bonds. They even had to come in and they said now they're going to buy ETFs, but not just any ETF. The ETFs of the investment grade bonds. You're going to LQD and some of these others that are more high grade ETFs, so that the net asset value the net asset value stays in line with the underlying assets. So you're going to see that the Feds are going to be doing a lot of this kind of thing. Okay. And if we look at currencies here, I'll show you the dollar. It's really amazing. The US dollar, look at this move here, guys. The dollar just exploded higher. In times of severe stress, everybody wants to hold a dollar, and that caused a lot of pain. No bank wanted to give up their dollars, and the Feds had to come into the tune of over $1 trillion and do these reverse swaps where they were coming in and supporting buying dollars, selling dollars to banks, just doing everything that they could to get the dollar down. And you can see what it did. It brought it back down here, but I think it's not going to go too much lower. It's going to stay in this area here. They're going to have a hard time until we get through this. Now, fortunately, this crisis is not systemic and structural like '08 and '09. That was a systemic structural issue of, well, gee, will the bank survive or not? I mean, what will happen? That was a structural issue. This is a binary event where it can get worse if it's extended another, let's say, 2 months out in time. It'll affect Q1, Q2, and possibly Q3 GDP. But if it's only affecting Q1 and Q2, then I think you'll see a very quick or a quicker recovery. Not V-shaped, but a quicker recovery. Still doesn't mean we can't come down and make new lows, because I believe we can. The charts seem to indicate that we will. We're going to follow them with our members, but this is kind of what I'm seeing here. Now, one thing that I was telling our members, there were some great buys over this past week. Some of our members did very well. One of them was in the British pound. I mean, when the pound came back down to $1.14, I mean, that's just a screaming bloody buy all day long. Okay. And the risk of not doing that was, in my mind, the risk reward was just too compelling. So either going long the British pound or going long FXB. And if you look at FXB, which is the ETF that tracks the pound, right? You can see the same thing. I mean, look at this. Gap, 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 gap. I mean, it was just like, when it's down at this level down here, I mean, it's just like going with both hands. And it moved up a pretty good bit. You know, this is 8%, 9% on FXB, but with, structuring it the right way with options, you could have done fairly well with this one. So, this was one that I was talking to our members about. Now the move has already happened. I think it has a possibility of kind of stalling out here, coming back down a little bit. There were several others like this in the commodity space that I was suggesting for our members. I'll go through this in more detail on the week tomorrow night session. And if we look at metal, let's look at gold for a second. This has confused a lot of people. Gold had a 1704 high print for the year. It says 2019, but it really should be 2020. In fact, let me change that while I'm here so that I can get this thing on here and get it correct. Let's get that changed here. So even though, and I'm just going to save it. Let's just save all of these pages here so I don't forget. Even though we had the high print, we came all the way down, and inside of a week, a little over a week, we had a 2020 high and we had a 2020 low. It moved from 1704 down to 1450. Right? That is a huge move in less than a week. Now, gold traditionally is not a good thing to hold on to in a severe bear market because people are selling everything. They're throwing the baby out with the bathwater to just get rid of everything due to margin calls and everything else. So they get rid of gold. Once things settle down, gold should have a nice rebound. That's what we're getting right now. I think gold, if we have another scare, you'll see gold probably come back down, but use any downdraft in gold just to pick up a few things. Like there are a couple of things I'll talk to our members about that I like holding here in this area. But at this area right here, I wouldn't chase it at this level. Although you can see it's almost like bull flagging right here in that pattern. But that's kind of what I would look at here in the metals market. Now, the other thing, we did not get the signal, but we've made a ton of money in palladium. This move here in palladium was ferocious. It was about almost a $90,000 per contract move in palladium. And then you can see this huge bounce off the floor right here. But I think this thing is going to roll back over and come back down again. So I think palladium is going to set itself up for another rollover here. Now, palladium does not use options. It only has futures, so you can't hedge with a long call or a long put, depending on your futures contract, whether you're long or short. So it tends to exacerbate the move here dramatically. Even the ETF does not have options in it, so it's just an anomaly. And but I do believe it's going to come back down it's going to break 1200 and come back down into a lower area here. So that's kind of where I see palladium heading. It just got so over exuberant to the upside the end of February that it's just given it all back up. Okay, so that's palladium. There's some others out there that members I will show you this weekend that are setting up for another possible play. Now let's look at oil. Oil is going to be really interesting. You can see with oil, we're near our 2020 low. The 2020 low was 1946, and we're coming back down. I think we're going to take that level out. And if we get a little bit lower, there's going to be some actions I'm going to suggest to our members that I'm going to be taking. They can follow along with me if they want. But generally, these kind of actions generally result in a good high risk reward rate or low risk, high reward kind of ratio. So we're going to be look at that in the oil market. So there's nothing set up with a high risk reward ratio or a low risk, high reward ratio in ag, meats, or softs right now. But I'm starting to see it shine in energy. Not as much in metals. Currencies, yes. Treasuries, not so much. And volatility, yes. So there's going to be some areas here of some plays. Now, I've also listed to our members about 20 some odd stocks that are really good buys if you just nibble around the edges right now. We picked up some. We've had some good bounces in some of these also. I'll review those again this Sunday. If you're not a member of our group, I highly encourage you to come in and join us. These markets, when you get these over exuberant moves up and down, if you don't panic and you relax a little bit, you can take advantage of them. That's kind of what we're going to be doing here over the next probably 60 days as the markets try to carve out their bottom, and we see how these number of new cases are reported out of New York, and then as we switch, possibly it looks like New Orleans is starting to get on with a lot of because they held Mardi Gras there, if you can believe that. So that's going to spread that like wildfire through Louisiana. All right, everybody, that's the update for this week. Stay safe, social distance, hand sanitizers, and just kind of hang in there. I believe we're probably about a month or so away from getting a little bit of a drop in new cases, and that should also provide a little bit of a lift to the markets. Near term, I think we could go chop to probably find a new low, but I don't think it's going to be. And just remember what I said about volatility. I think it's going to slowly kind of wane a little bit, give or take 1 or 2 days of spikes, but that's a little bit about what I see. All right, everybody, have a great weekend. Members, I will see you this Sunday evening for our weekly market watch. Take care, folks. Ciao now.